Picture this with clear numbers rather than nostalgia. On September 19, 1949, the British Chancellor of the Exchequer told Parliament that sterling would be cut by 30% in a single stroke. That announcement was not clever policy engineering. It was an admission that arithmetic had cornered an empire. The currency that underpinned a quarter of the world's trade had to be marked down because the state that issued it was over-leveraged and illiquid. People still argue about motives and morality, but the mechanism was debt. And that mechanism is the point of this video, because the United States is now walking the same path, step for step. Keep the narrative, but delete the romance. Before 1914, Britain was the world's banker, the City of London, the clearinghouse of trade, and sterling the contract language of the age. Debt sat near 30% of GDP after long discipline. The country could borrow long in its own unit at modest coupons, backed by vast overseas assets and invisibles: shipping, insurance, merchant banking, and exchange finance. The system looked permanent because for a century it mostly worked. World War I detonated that structure. The Treasury's liabilities jumped from roughly $650 million to about $7.7 billion in 5 years. Exports shrank, gold stocks drained, and the state paid for munitions by selling foreign securities and issuing money. Britain flipped from net creditor to net debtor by 1918, mostly to the United States. Through the 1920s, leaders tried to restore the pre-war order, including a return to the old gold parity. Deflation to defend that level crushed tradables, kept unemployment elevated, and left the economy brittle just as debts matured and markets evolved away from city dominance. World War II completed the balance sheet collapse. Debt exceeded 200% of GDP. Military absorption hit more than half of output at the peak. Exports were disrupted, domestic consumption rationed, and the economy survived on American supply lines and credit. Meanwhile, Whitehall booked purchases from allies and colonies as sterling balances credits in London, promising later settlement. India alone accumulated claims of roughly $125 billion, Egypt around $450 million. Others added more. John Maynard Keynes tried to negotiate partial cancellation, warning that otherwise Britain would have to abandon costly outposts across the Mediterranean, Middle East, and Asia. He proved right. In September 1945, Lend-Lease ended abruptly. Britain then negotiated the 1946 Anglo-American loan, $3.75 billion from the U.S. at 2%, plus $1.9 billion from Canada with conditions. The most punishing was convertibility. Once sterling became convertible into dollars in 1947, holders of balances rushed through the only open exit. Dollar reserves collapsed within weeks. Convertibility was suspended. Emergency cuts followed. 2 years later, the government devalued sterling by 30%. That act ended the pretense that the pound could anchor the system as before. Debt did more than break the currency. It broke the empire's operating model. In 1947, Britain conceded Indian independence primarily because imperial administration and defense were unaffordable. In 1948, London withdrew from Palestine and asked Washington to cover Greek and Turkish security, producing the Truman Doctrine. The ultimate punctuation mark came in 1956. When Egypt's Nasser nationalized the Suez Canal, Britain, France, and Israel opened a military operation that initially met its tactical objectives. Markets reacted to reserves, not maps. The Bank of England bled dollars rapidly, and the Eisenhower administration threatened to dump sterling and block IMF support unless London accepted a ceasefire. Prime Minister Anthony Eden complied within days. The message was unmistakable. When creditors control your margin of safety, military success cannot buy strategic autonomy. The pattern did not stop there. In 1976, amid inflation and stagnation, the pound slid and gilts could not be floated on tolerable terms. The government requested an IMF package of $2.3 billion, at the time the largest draw ever, and accepted conditional spending cuts. For a country that once underwrote global finance, this was a public tutorial in humility. Even the final accounting hurt. On December 29, 2006, Britain made the last World War II loan payments to the U.S. and Canada small checks by then, but symbolic of 6 decades in which interest doubled the original principal. shift to the United States. The analogy is not perfect, but the rhyme is clear. Federal debt has crossed the 30s of trillions, with debt to GDP roughly in the 120–130% range depending on the measure. Net interest outlays have surged and in recent data have rivaled or exceeded defense spending. Baselines show debt climbing past $50 trillion by the mid-2030s if policy does not change, with interest the fastest growing line item. The arithmetic is impersonal. If the primary deficit persists while the average interest cost rises faster than growth, debt ratios worsen by identity. Military posture also echoes the British cycle of overstretch. The U.S. maintains hundreds of overseas facilities, sustains forward presence in Europe, the Middle East, and Asia, and has spent many trillions on the post-9/11 wars when veterans' care and interest are included. Defense outlays approach $1 trillion and exceed those of the next several countries combined. Such networks are affordable only as long as markets happily roll and expand Treasury funding at low yields. Reserve currency dynamics deserve careful, unemotional treatment. Sterling's breakdown from 1944 to 1949 was accelerated by parities and the convertibility shock that turned accumulated claims into immediate drains on dollars. The dollar today is embedded in a floating system, deeper markets, and a web of global liabilities priced in dollars. Yet the direction matters. The dollar's reserve share has slipped from the 70% to the upper 50s as central banks diversify. Sanctions have accelerated investments in alternative rails. None replace the dollar today. Enough trim its monopoly rent to shave the margin of error tomorrow. Creditor dependence is another rhyme. Britain could not ignore American preferences in 1956 because Washington was the lender and the gatekeeper to the IMF. Post-war sterling balances in India, Egypt, and elsewhere constrained policy. Today, foreign holders own many trillions in treasuries. China's holdings are only part of the picture. Europe, Japan, and surplus economies in Asia and the Gulf are also central. A coordinated duration, shorten, or a credibility shock that widens term premia would raise funding costs quickly and propagate through mortgages, corporate debt, and state budgets. Historian Niall Ferguson popularized a rough rule. When interest costs exceed defense, a great power is in the danger zone. The reasoning is not mystical. Interest is the price of past decisions. When it outruns the price of current security, strategy must compress unless revenues rise or other spending falls. That is the point at which commitments begin to be trimmed, bases consolidated, procurement delayed, and influence traded for time. Britain crossed that territory in the 1940s and 1950s and met the consequences in 1956 and 1976. What concrete indicators should you watch? First, the gap between net interest and defense outlays over multiple quarters, not a single print. Second, the dollar's share in official reserves and the share of commodity invoices settled off dollar. Third, the growth of cross-border payment channels that do not require dollar clearing. Fourth, evidence of forced retrenchment, unplanned base closures, hurried withdrawals, and budget caps that squeeze maintenance and training. Fifth, signs that creditors are dictating terms lending conditioned on specific fiscal or external targets rather than on broad confidence. For households and businesses, the translation is practical. A large devaluation, like Britain's 30% cut in 1949, destroys purchasing power for pure cash claims. Portfolios concentrated in a single currency embed tail risk. Sensible hedges include some allocation to real assets with low counterparty risk, some exposure to non-dollar currencies, and skills that retain value regardless of exchange regimes. Operating resilience liquidity buffers, diversified suppliers and customers, flexible cost structures carries real option value when funding costs jump. Now, be fair to America's strengths because they matter. The U.S. economy is far larger relative to world output than Britain's was at its peak and more diversified. It enjoys near-continental energy and food endowments, world-scale technology firms, deep venture and capital markets, and reserve currency incumbency that lowers funding costs. Geography removes peer invasion risk. These advantages widen the window for reform. They do not nullify the budget identities that eventually disciplined Britain. Policy can still move first. How does a regime shift actually happen? Often slowly, then suddenly. In 1938, Britain looked functional, even after World War I damage. By 1947, convertibility failed within weeks. In 1956, battlefield success in Egypt ended in financial capitulation in days. In 1976, bond markets forced a letter of intent with the IMF within a quarter. For the U.S., plausible triggers include a major conflict that lifts spending while suppressing growth, a self-inflicted debt ceiling crisis, a banking shock that forces rapid central bank balance sheet expansion, or a coordinated decision by large reserve managers to shorten duration and test auction depth. Policy options are not glamorous, but they exist. Narrow the primary deficit across the cycle. Prioritize high multiplier public investment over low return outlays. Broaden the tax base rather than only ratcheting rates. And maintain predictable, rules-based monetary policy that avoids financial repression. Align defense posture with resources by cutting lower value commitments rather than hollowing out readiness. Keep markets open and Treasury collateral pristine to preserve the dollar's incumbency. None of this sells t-shirts. All of it buys time. If the plan fails and the dollar's role erodes, the personal effects are direct. Savings in pure cash lose purchasing power. Dollar assets face relative repricing, and imported goods become more expensive. Governments under stress raise revenue where they can and tolerate higher inflation than they admit. Businesses with rigid liabilities and thin margins struggle. Households without buffers become policy's shock absorbers. The British experience is not a museum piece, it is a map. Return to the original claim, Britain did not lose its empire because a decisive army defeated it, or because ideology changed overnight. The empire ended when the money that powered it no longer cleared the bills that sustained it. Debt service, balance of payments gaps, and creditor power did the work that navies could not undo. The United States is not condemned to that outcome, but it rhymes with it when the numbers trend the wrong way and politics delays correction. So, what should you do now? Diversify exposures, invest in portable skills, build redundancy into income and location, and watch the indicators before the crowd recognizes the pattern. Preparation is not pessimism, it is the opposite. The British story proves that societies can remain rich, free, and innovative after losing imperial status. It also proves that autonomy shrinks once creditors price your options. If you want to keep choice, keep the balance sheet credible. Empires fall to math. Markets settle arguments that politics postpones. The bill always comes due. The only real question is whether policy moves first or confidence moves first. Britain waited. In 1949, the pound was marked to reality. In 1956, strategy was marked to funding. In 1976, domestic policy was marked to an IMF term sheet. The United States can still choose a cleaner path. Reform before stress. If we do, the glide path can be managed. If we do not, the reset will be abrupt and externally timed. Leave a comment with your take and tell me which indicator you watch to gauge whether America is approaching its Suez moment or avoiding it altogether. Key mechanics that turn strength into fragility for Britain deserve crisp enumeration. 1. The creditor-to-debtor flip after 1914 severed the interest income that had funded imperial policing. 2. The interwar decision to chase the pre-war gold parity forced domestic deflation that weakened export capacity just as war debts matured. 3. The invention of sterling balances during World War II created callable claims that could transform into dollar drains the moment convertibility opened. 4. The post-war choice to bind imperial defense to external borrowing let creditors set conditions. 5. Suez proved that financial leverage trumps tactical success when reserves are thin and backstops conditional. Map similar mechanics onto the U.S. 1. Persistent primary deficits since 2001 turned cyclical borrowing into structural habit. 2. Demographic pressure lifts mandatory spending while tax bases lag, raising the share of outlays financed by new debt. 3. A higher term premium and rollover of low coupon debt into higher coupons crank net interest faster than growth. 4. Sanction policy that treats the dollar like a weapon incentivizes counterparties to build alternatives. 5. Supply chain rewiring and industrial policy add fiscal demands even as revenues lag implementation. Numbers clarify the compounding. Suppose debt held by the public grows from the mid-20 trillions, and the average interest rate drifts a percentage point higher, while real growth and inflation do not accelerate. Net interest then climbs almost automatically, crowding out discretionary space. If the primary deficit is not tightened, debt dynamics deteriorate even if the growth outlook is serviceable. That is not doomsaying. It is the same arithmetic that killed the pound's preeminence when the external account would no longer fund imperial overhead. Consider balance of payments transmission. Britain in the 1940s needed dollars to import food, fuel, and machinery. If sterling claims converted into dollars faster than exports earned them, reserves fell. Policy then contracted imports, cut military stations, and rationed goods. Today the U.S. issues the very assets the world uses for reserves and collateral. But if major reserve managers diversify and private actors shorten duration, Treasury must pay higher yields to clear auctions. That hits mortgages and capex, slows growth, and feeds back into the deficit. A short glossary keeps the debate precise. Sterling balances. Wartime credits recorded in London in favor of allies and colonies. Payable later in goods or hard currency. Convertibility. The right to turn sterling into dollars at a fixed rate. In 1947, this right triggered an immediate drain. Exorbitant privilege. The benefit of issuing the currency others hold for safety and liquidity, letting you borrow long and cheap. Primary deficit. The budget gap before interest. If positive while debt is high, it ensures compounding. Skeptics argue the dollar's network effects dwarf sterling's, true and important. The modern dollar is embedded in derivatives margining, global bank balance sheets, commodity invoicing, cross-border credit, and collateral chains. Displacement would require parallel systems with comparable depth, rule of law, and convertibility that can survive stress. That is not on the near horizon. The lesson is not collapse now. It is buy time with discipline before time buys discipline for you. What would disciplined policy look like in practice? On the fiscal side, multi-year caps on real primary spending growth paired with base-broadening tax reform, fast rollout of permitting reform to accelerate private investment in power, chips, and logistics, and credible long-run adjustments to healthcare and pension cost growth. On the defense side, concentrate on deterrence by denial in priority theaters, reduce low-yield presence missions, and protect maintenance and munitions accounts. On the monetary side, keep inflation expectations anchored while avoiding balance sheet policies that substitute for fiscal choices. Household and firm playbooks can be explicit without hype. Keep 3 to 6 months of expenses in highly liquid, diversified cash vehicles rather than a single bank. Hold some inflation-resistant assets such as short-duration TIPS or quality equities with pricing power. Avoid excessive leverage on variable rates. If you manage supply chains, dual-source critical inputs, and pre-negotiate lines of credit. If you manage a portfolio, set currency risk limits and review collateral wrong-way risks. If you plan a move, evaluate jurisdictions by fiscal health and property rights enforcement. History offers counterpoints and nuance. Britain, after empire, built a service-driven, innovative economy and remained a core financial center. The city adapted by specializing in global intermediation, even without a reserve currency. Likewise, the U.S. could remain the world's largest economy and a leading innovator, even if it shares reserve status more evenly. The difference is autonomy. The more you owe to outsiders at floating rates, the less room you have when shocks arrive. Revisit Suez as a case study in financial leverage over force. The Bank of England's reserve bleed was modest in absolute dollars, but devastating at the margin because it signaled that the lender of last resort, Washington, was unwilling to backstop sterling until London accepted a ceasefire. That is the core asymmetry of creditor power. It does not require selling every bond. It requires convincing markets that your central bank will not burn reserves to protect a policy you cannot fund. In that moment, spreads do the work. Revisit 1947 convertibility as a study in sequencing. Britain tried to liberalize before rebuilding export capacity and dollar reserves. The outcome was predictable, a run. The policy lesson is to fix the earning engine first, then open the capital account. For the U.S., the analog is different. Keep the markets plumbing flawless so that diversification by some holders does not become a plumbing accident that forces yield spikes out of proportion to fundamentals. Revisit 1976. As a lesson in communications, markets doubted fiscal control, gilt sold off, sterling fell, officials promised restraint, the IMF forced specifics. The parallel today is that frameworks beat slogans, publish glide paths, lock rules in law, and let automatic stabilizers work. When investors believe the rule set will survive elections, the term premium falls and policy space expands. Finally, weigh the timeline honestly. Britain's slide took roughly a generation from 1914 to 1949, with aftershocks for decades. The U.S. has spent more than 2 decades in structural deficit mode. That does not preordain a crash, but it narrows the margin for error. The reasonable baseline is not collapse, it is pressure. The wise response is not panic, it is early adjustment. Your personal bottom line remains simple. Do not assume status quo funding forever. Respect tail risk. Diversify sensibly. Build cash buffers. Reduce fragile dependencies. And watch the real-time dashboard. Interest to defense, reserve shares, auction performance, and signs of forced retrenchment. Empires may be narratives, their constraints are math. Prepare accordingly. One final note. Preparation beats prediction. Avalanche sheet priorities and humility about arithmetic build dressily ends when confidence wavers. Choose adjustment over denial, discipline over drift, and optionality over wishful thinking.